what I want to try and convey in a short period of time compared to how much information I wish we all had is how to not ride it over the top. And that's the way that I view what happens altogether too often in companies, where we miss the opportunity to exit near the peak in the value and end up passing that period and ending up with less than we could have if only we had timed it right. And I was interested in James Black's answer when somebody asked him, about riding it over the top, because of course where he lives in an exchange, you have the benefit of seeing the price of the stock all the time. And you can go back and download it into Excel, the history of the company's value, and you can exactly see when it peaked in value. There's no mystery about when that happened. The work that we do, though, is quite a bit more difficult because we don't have a stock chart that we can use to gauge how that company's value is increasing or decreasing or changing that in that period of time. But nevertheless, even though we don't have the data we would wish to have, we've got to make the same decisions. And I think that timing is a very important part of the exit strategy and planning. And one of the things to take into consideration to answer the question that was asked earlier about how do you know when the right time is that the process of the exit has a time delay of about 6 to 18 months. And what I mean by that is that when the decision makers in that company decide we're going to sell the company until the cash is in the bank is going to take 6 to 18 months. And I hate using that answer because I'm an engineer, and if somebody gives you an answer that's got like a 3x range, that's a pretty useless answer. But the truth is, you can't be more specific than that until you know the answers to some of the things that Fiona was talking about in terms of what kind of cleanup do we need to do. Sometimes that cleanup can take a year to get the company ready to enter the market. There can be similar challenges with the tax structure, like Steve was talking about. So there's a pretty big range of how long it's going to take from when you actually resource the process till when the check is in the bank. And one of the other things that's changed a lot just in the last couple of years is that the internet has accelerated almost everything in the business world and many other parts of our life as well. But we take for granted that this wonderful new technology allows entrepreneurs to sell products to everywhere in the world in a very short number of days. But it's also changed other things. I'm sure here it's quite common to hear the term weekender, where entrepreneurs get together for a weekend with the goal of building an entire company and getting that company into revenue. When I was a young entrepreneur, no one even thought of that. No one even thought it would be possible to build a company in a weekend. Well, when I wrote the book Early Exits in 2009, I speculated that one day they'll probably define an early exit as selling the company before the end of the weekender. That same year, it actually almost happened. That same year, in November 2009, a group of crazy entrepreneurs in London built a business in one day, and they videotaped the whole thing. And the reason they did that is building a business in 2 days was by then passé. It wasn't even impressive anymore. Building it in one day was kind of interesting. And what they ended up doing is they ended up selling it in 10 days by auctioning it off online. So that was a stunt, and it's kind of a funny 2 or 3 minute video. But it's a good illustration of how much compression there's been in the corporate life cycle. I mean, this wasn't even possible before. A much more relevant example is a website called Flippa. And Flippa is a bourse. It's a place where things are bought and sold. But these are companies that are worth tens of thousands of dollars often, maybe hundreds of thousands of dollars. So it's a place where every day they buy and sell entire companies for much smaller amounts than I would have thought was possible. Again, the internet makes this possible to do a transaction of that size. But the time is to me something that really got me thinking about how today's entrepreneurs are working to a whole different timeline than we did when I was starting out. What I want to show you is some examples, which I admit I have pre-selected to illustrate a point. This is not a representative data sample. This is just companies that I've noticed that I thought were interesting. And what I'm going to show you here are companies that sold 2 or 3 years from startup, but sold for quite a lot of money. One I mentioned earlier is Club Penguin, company from Kelowna, again in the central part of British Columbia. That company had less than $100,000 of friends and family capital. None of us angels were invited to invest. They didn't need our money. It sold for $350 million when it was 2 years old. YouTube, we all know, sold for $1.6 billion when it was 2 years old. Playfish got $275 million at 2. Mint got $170 million at 3. AdMob was sold for $750 million when it was 3.5 years old. Twitch sold for $970 million at 3 years old. And Oculus VR last year, which was crowd-funded in 2012, August of 2012, crowd-funded, sold for $2 billion when it was 2 years old, still in development. And again, I pre-selected those. That's not data. Those are just observations. But it's interesting. These aren't small exits. They're early, but they're not small. The wealth is being created faster than it's ever happened before in history, and I think the internet is the single biggest reason for that. Here's an example of those accursed NDAs I talked about before. I'm really hoping I can talk this entrepreneur into thinking that he's fulfilled his obligations under the NDA so I can tell this whole story at some point in the future. But this is a Vancouver company. It was a classic startup. I can't tell you the name of the company, but what they did was what all good entrepreneurs should do, is before they built their product, they sort of test marketed it. So this was literally 2 engineers. They had an idea for a product. They did some drawings. They went out and they asked a handful of what they thought were potential customers if they could build it for this much money, how many would they buy? Very good thing for entrepreneurs to do. What they weren't expecting was the conversation quickly shifted to, we'd like to buy the company. So they called me up all out of breath, saying, help, help, we haven't got the product built yet, but they already want to buy the company. And to make a fabulously fun story short, 3 months later, the money was in the bank. And now this isn't enough money to never work again. This is millions of dollars, though, like real serious money. And this company was less than 12 months from startup. I was helping them with the due diligence, and it said things like financial statements. We wrote NA. There weren't any financial statements. There was no tax returns. This was literally a startup with an idea. They had done one smart thing, though. They had filed a couple of patents. So they had only spent about $20,000 to file the 2 patents. They were just applications. But this US company saw what they had. They liked it. They knew they would buy a lot of it. For them, like so many of the medium and large-sized companies, they needed the innovation. So their reaction, very predictably actually, was just to buy the whole company. I see that happening over and over again. Last month, I helped a company close a transaction. Another company over where I live, it was a software company. They called on what they thought was a strategic partner, a larger US company. They were hoping to get a minority equity investment. It wasn't a very good idea. They were looking for angel capital. They went to a corporation. Same thing happened. We don't invest. We don't make minority equity investments, but we'd like to buy the business. Sold the whole company before the software was finished. And again, nice 7-digit numbers. Not retirement forever, but wow, very much worthwhile. I would call those accidental exits, things that we probably miss every day in our portfolio companies. But it's a good illustration, again, anecdotal information, but a good illustration of just how active this M&A market is. One of the ones that I really admire is a company called Pumpkinhead, which no one's ever heard of, but most people have heard of the product About.me. And this company was acquired by AOL 4 days after the product launched. Now, I don't think that's the right way to measure it, even though that's probably a record. I think you got to measure it from startup. But it was about a year old when they sold it. And what was interesting to me is that I was impressed by this. And I went and looked for what I could see online. And I found a picture of the founders. Those founders had way more gray hair than I have. And what this was a group of serial entrepreneurs who had done this about 6 times before. They'd actually sold companies to AOL before. And these guys, this, again, very impressive, very smart group. They knew exactly how to do it. And I don't know this for a fact. I'm speculating, but I know how long it takes to sell a company. they must have started the exit process at about the same time they started the software development. It's the only way they could have got it done in a year. So what this very impressive team did is they hired some developers and they resourced the job of selling the company. They moved both processes together in parallel, launched the product, closed the deal 4 days later. That's impressive. That's another illustration of what's possible today. And in an ideal situation, what I wish would happen is that the board of the company would think about this 6 to 18 months delay and then factor that into the company's strategic and operating plans. And then if we could, look forward in time and start the exit 12 to 18 months before the peak in the value. Again, highly, unrealistic, but that's what I wish happened. And what I'm trying to say, though, which is much more applicable, is how the ideal exit timing, if we could do it, would look. So in the early days of the company's growth phase, it's growing really quickly. Young companies, like young children, just naturally grow quickly. It's easy from a small base. And then if we had perfect foresight, we would start the exit 12 to 18 months before the peak in the value, and we'd sell the company at the peak in the value. Of course, that never happens, but this is just a thought model that I'd like you to think about. But what unfortunately happens most of the time is that instead of doing the optimum, what most of the time we do is we wait too long. We wait until it's starting to become obvious that the company's best days are behind it. And then we start the 12 to 18 month process, and we end up exiting far past the company's peak in the value. And the reason is that by the time the buyers come along and get serious about the due diligence, it's obvious to everyone the company's past its peak in value. And sometimes it's hard to see that this has happened. It's hard to look backwards in a private company. But if you're close to the company, very often you blew the perfect time. You can sometimes look back at the previous financings and realize they were at a higher share price than you sold the company for. That's simply because we're optimists. The angels and the entrepreneurs are eternal optimists. We have to be to do what we do. And we're really good at seeing the potential for a company to grow, but we're not nearly as good at assessing the risk. And that's what causes this to happen so often. And of course, what this sad picture shows us is an enormous financial loss. It's all that value that was squandered, that was lost, that was never realized simply because we got the timing wrong. But for the entrepreneurs, it's much worse than that, because what they did is they invested part of their lives in operating that company, going to work every day, sweating their hearts out, working hard as they went home every day poorer, just because they missed the best time to exit. And that's a part of their lives they're never going to get back. It's a part of their lives they could have stayed in the most expensive resort anywhere in the world and just did nothing for that period of time instead of going to work every day and watching the value of their company go down. But both of those are still optimistic scenarios. What's really terrifying is what usually happens, which is that if you miss the optimum time, there's a terrifying probability that that company won't just exit later for less, but it won't exit at all because it will completely fail. And this is another one of those things that you haven't heard before. No one's been talking about this yet. And when I started to notice in my own backyard how consistently that happened, of course, my big question was, why? Like, what are we missing here? Like, why am I feeling this financial pain every time the company misses the optimum time? I'm getting the tax write-off. Why are there so few exits past that optimum? And what I started to realize after seeing this over and over again, that there's actually logical reasons that this happens. And there's logical reasons why if you miss it, the chances are you're dead, even if it's going to take a few years to happen. And these are the risks that we're not good at assessing. These are the things that can happen that end up killing our young companies when it wasn't necessary. And there's 5 categories, and I'm going to go through these fairly quickly because I want to give you these that you can think about, and we could do a whole workshop just on these 5 reasons that companies that miss the optimum time fail. But quickly, I'm going to throw these out and we'll have some questions. Overinvestment by VCs, still a significant factor. There's still more venture capital around than there is a need for venture capital. Competition, intellectual property infringement, negative momentum, and waves of consolidation. So quickly running through those. Overinvestment happens when a sector becomes hot. And that's when the VCs will often invest simultaneously in multiple companies, all of them hoping to fund one of the few winners in that new area. And it's still a reality because there's too much venture capital that the VCs that invest usually invest more than the companies really need, still today. And typically what they need to do in these big funds is they need to write $10 million, $20 million checks. They can't afford to invest smaller amounts. This overinvestment often drives out the innovators. It often drives out the people who found the market first, were funded by angels. They can't outperform somebody who's burning at 10 times the rate. And this often happens because these startups create the seeds of their own destruction by creating competition. And what happens also, regardless of the venture capital, is that when a startup succeeds because they find a new market or a new technology, or they recognize a new trend, they'll start making noise about their success, obviously partly to generate new business. That success also creates awareness and attracts new entrants to the market, just as the market's maturing and becoming more expensive to operate in. The technical term that the entrepreneurs use for this is being a fast follower. It's another one of these things nobody had ever heard of before, but is a whole subset of entrepreneurial activity that is optimized around being a fast follower. And these are people that recognize they're not smart enough to come up with the innovations, or that that's just too hard to be predictable. They just lay in the weeds and wait. And when they see a good market opportunity, they jump on it, figuring that they can execute better than the original guys who came up with the idea. And a lot of times they can. So the competition, we've always had competition, but today's competition is much faster and much fiercer than ever, in part because all of this information is so readily available on the internet, and because there's been some really successful fast followers. And other entrepreneurs are going, hey, maybe that's a good business strategy for us to follow. Patents are another one of the fascinating, fairly new things that I'm seeing in the exit market. And of course, we've had patents for like 100 years, multiple 100 years, I'm not even sure. But today, patents are a much more valuable tool for entrepreneurs and angels. And that's because the attitudes about patents are changing globally. And America recently changed their patent system to be, like Canada's has been for a long time, being a first-to-file system. That completely changed the rules. And they also, at the same time, did something we don't have, which is built a rapid approval process. So today, if you want to spend a bit more money in America, you can be pretty sure you can get a patent granted, if you're going to get it granted, in only about a year. And what has happened is that there's been changes in the legislative and common law in how patents are being decided, mostly in the US, and we kind of follow here in Canada. They all have been benefiting the entrepreneurs and the inventors. And there's been some huge wins lately in the patent courts for the entrepreneurs. And this is a subset of a global change in attitude as we struggle in North America to find enough jobs for our people. And one of the interesting things about this is we're seeing more and more entrepreneurs cash in on patents, but we're also seeing an increasing threat to entrepreneurs. So we're really good at the cashing in part, but we're not so good at seeing the threat part. And one of the realities of a patent is you never really know if it's valuable until after the appeal. And what I'm saying is, not the court case, but the appeal. And the challenge with a patent litigation is it can easily take a decade from the time that it starts until it's over. And with technology companies, you just can't wait that long. 10 years is an eternity. I mean, the whole patent's only good for 17 years anyway. And if you have to fight it, 10 years is forever. And the big companies, especially in Asia, and I don't want to be categorizing a culture here, because that's not right, but it does seem that if you look at the cases, there are different cultural values around intellectual property in different parts of the world. I think that's a fair comment to make. And in Asia, what's happening is they're increasingly taking the attitude that they're just going to use the IP and let the lawyers figure it out later. And this has always happened to a certain extent, but now it's endemic. It's the way that business is done in the tech world in most of the global companies. And so what I was kind of curious about this, and I've had the opportunity to ask a few patent lawyers what it would cost if you wanted to prosecute a patent. So let's say some big company just ripped off your IP. What would it, and you wanted to make it right, what would it cost? And it's hard to get a clear answer on that because, of course, it's a highly variable cost. But one of them said to me it would take $1 million for the retainer. So you want to fight some global company on a patent, the lawyers wanted you to put, the initial down payment is $1 million, they said, to do a big patent battle. I don't know if you know whether you think that's high or low, but that's what this guy said. It's going to take, if you don't have $1 million, we're not even going to get into the game. And what they went on to say is it could cost $5 to $10 million to fight a patent battle. Because again, you got to go through the court case, you might have to go through an appeal, and 10 years is not an unreasonable amount of time to fight one of these things. Bill is nodding. So, and the other thing about this is you spend $5 or $10 million, and there's still a really high probability you're going to lose. This is another area where we don't have enough data. It drives me crazy, as you know. But PwC did an interesting study in 2012, and they studied patent litigation cases. And they said that there's about a 40% chance that the patent holder is going to lose. So that's a reality. That's a fact. What we don't know, but what I believe, is that those patent holders believed that they were right. Those patent holders believed that they had a good patent. Otherwise, why would they spend all that money to try and defend it? So what that says to me is, even when you believe you're in the right, and you spend a lot of money, it's still a 60-40 proposition, which is pretty scarily close to 50-50. And so what happens, and this is the really scary part, is that these small companies, these angel-backed companies, these inventors, often lose simply because they can't hire the very best lawyers. And with patent lawyers, like any other kind of lawyer or any other kind of professional, there's some people that are really good, there's some people in the middle, and then there's some people you really don't want working on your project. And some patent lawyers have looked me straight in the eye and said to me that the quality of the lawyer is more important than the quality of the patent. Now, they're patent lawyers, and they're litigators, and they're that's the nature of the beast. But I wonder how maybe probably that's got some validity. And what's interesting about these big companies, these ones with these cavalier attitudes, is they often employ literally hundreds of patent attorneys. They'll have a whole building full of patent lawyers. And they tend, as I've been told, not to hire those guys at the bottom of their class. They tend to find really good patent lawyers. And so what they know is, these big companies know that a percentage of the time they're going to win. They're playing the odds. That's just smart business for them. They also know that they're going to win much more often against a small company, because the small company can't really afford the best defense. So, and even worse, a lot of times the small company won't even join them on the battlefield. They'll rip off the IP. They might get a few letters. They'll thumb their noses, and the little company can't even come up with $1 million retainer. So if you're a big co, that's a perfectly reasonable business strategy. We're just going to grab this IP. We've got 300 lawyers on staff or whatever it is. They'll figure it out later. If we have to pay, we'll pay. But probabilities are pretty good. We're not going to have to pay at all. So what that's led me to believe that in this current market, if you have a good patent, the only reasonable strategy is to sell the company as soon as possible after the patent's granted, or as soon as the technology is disclosed. Part of me is very sad to say that. Part of me thinks that's not fair. Entrepreneurs come up with a good idea, they patent it, and then they have to give it up. But I believe that the risks of not selling that company are just not a good business decision or investment decision. So what I'm saying is, if you've got a company like we all want to find that comes up with something that's really valuable and they patent it, the only rational investment strategy is to sell that company right now. Sitting on that, you're out there in an environment where there's numerous predatory entities that you can't possibly reasonably hope to defend against. And for an angel, at least, it's just not a good business decision. Entrepreneurs, if they lose it all, they'll just start another company. But if you're looking at it as an investment decision, it doesn't make sense. Another one of the reasons that if you miss that perfect time, if you ride it to the point where that patent infringement becomes a reality, it's probably too late. Another really scary thing that I've seen a few times that results in these companies that miss the optimum time never exiting is something that I call negative momentum. It doesn't have a name. I'm not sure what it'll be called when this becomes more obvious, but it's what James was talking about when he said he sees companies riding it over the top all the time, because he can pull up the stock chart and goes, yep, that one rode it over the top. And in his world, when they crater, they become shells. They become companies that are still listed, but they don't have a business anymore. Well, if you're inside of a private company, you kind of get a feeling for how the company is doing. You can feel when the value has peaked. And the way that it feels is that it's not as much fun anymore. The excitement is gone. And maybe you're losing more bids than you used to, or there's fierce margin pressure. When that happens, is a really big danger, especially for these younger generations, for the best and the brightest to leave the company. They'll just go on somewhere that's more fun. And that can often cause other people who noticed that, hey, that guy was really good and he's gone, and that can actually create a cascade, a negative, self-reinforcing negative spiral where the company starts to have trouble retaining people simply because it's past the peak. It's not a fun place to be anymore. And when companies get into that downward spiral, it's like being in a plane where you've lost control and you're going to do what they called in Hot Gun auger in. You're in a dive and you're pulling on the stick to try and fix it, but there's momentum. And when you get into one of these negative momentum spirals in a company, I've seen this. I've invested in these companies. I've watched them, just fall off a cliff and then ultimately auger in, just because they somehow lost the excitement. They somehow went past the peak of where people wanted to work. And these days, that talent is so mobile, that alone is enough. And with this younger generation, I think that's probably statistically like 2 or 3 years out. Another reason to think really carefully about whether that might be the thing that kills your investment. The one that I find the most fascinating is the wave of consolidation. This is the last one of the 5. And this one's a little bit more complicated, and I'm going to go through it a little bit too quick because, again, I think we could spend an hour on this, and I want to leave some time for questions. But a wave of consolidation is a fairly new phenomena, again, accelerated by the internet. And unlike the earlier threats, if this happens to you, to your company, it's almost impossible to fix. And it's usually fatal. And heartbreakingly, it often takes years for the company to die after it's been killed. And the reason this happens is today we're all connected by the internet, and especially social media. And what it lets us do is it lets us see what's happening all over the world almost instantaneously. And in business, what that means is, unlike in previous times, competitors have access to almost exactly the same information today. And what that's causing executives to do is make almost the same decision at the same time in competitive companies. And for these medium and large-sized companies, they're growing primarily by acquisition. They've accepted that now. That's clearly what they're doing. And most of them have more cash than they can usefully deploy. And they're under pressure to acquire companies. And they're even going so far now in big companies, they make it a line item in your performance-based comp plan. How many companies did you buy this year? If you bought one, you get a bonus. Like, they'll pay their executives more. So now you've got these people that are, every time they look at a potential strategic partner, they're thinking acquisition with a dollar sign over it at a personal level. But because these buyers are all connected so effectively by the internet, by the social media, they'll all make the same decision at the same time. So, for example, let's imagine industry where there's 3 big competitors. Those are all run by smart executives. You can be sure that those people in those big companies at the high level, they're smart. They probably all have more cash than they know what to do with. So when a new market or technology creates an opportunity to grow their business, they'll probably all see it at about the same time. Sometimes it's an external event. Sometimes something will happen that causes them to have this realization at the same time. But they'll often all decide at the same time to acquire a company in a certain space. And sometimes what happens, by the way, is one of those target companies will decide they want to be sold. So what they'll do is they'll engage an M&A advisor. Today, in this world that we live in, even for a medium-sized transaction, M&A advisors will probably contact every buyer in the world, or attempt to contact every buyer in the world. It's not that hard anymore. So one M&A advisory team, let's say 3, 4 people, will go out and describe an opportunity to all the executives in, let's say, 50 or 100 companies at the same time. And if they're right, the light bulb will go on simultaneously in quite a few of those companies. And if an acquisition makes sense for one of those big companies, it probably does for the others as well. And of course, this is what M&A advisors live for. So you get this feeding frenzy, you get this multiple bidders, the price goes crazy. That's all great. But these buyers are smarts too. And regardless of where they got the idea from, once they decide they want to acquire a business in a certain area, they will also look at almost all the companies in the world. Again, we live in this wonderful era where information is much more available than it's ever been before. And what they'll also do is they'll go out to what they call in the industry buy-side M&A advisors, companies that specialize in helping companies buy. And they will also fire up teams of people using every research tool that's available in the world and find every possible target company in that entire sector in the world. And then they'll go out and make direct, unsolicited offers to acquire. And the buyers, it's always important to understand the motivation of the people across the table. The buyers are doing this for a couple of reasons. One of them is they want to determine which is the best company for them to buy. And they want to have more choices because that gives them more negotiating leverage. But really, I think most importantly, they want to ensure that if they don't win the competitive bidding process for their first choice, they'll have a backup choice. And what's happening there is that the people who are in the corporate development teams, the people who are in charge of buying companies, don't want to go to their boss and say, probably the CEO, and say, gee, I know you upped the offer twice for that company we were trying to buy, spent the last year trying to buy. Bad news, boss, we came in second. Nobody wants to do that. So what they do is they'll have backups. They'll have 3 choices probably. And so all of this activity creates a cascade of events. And these big companies get more people into the mix. And the result of this is every company in the world soon will have had a phone call. Every company in the world will have had somebody phoning them saying, hey, we see an opportunity to sell a company like yours. Are you interested? And that's the beginning of the wave. When that starts to happen, and if it ever happens to one of your companies, it's probably the worst thing you could imagine. And it's really interesting because as this momentum builds, sometimes the CEOs will think, oh, I've got a really hot area. I'm golden. I'm getting all these calls from people who want to buy the company. If you ever hear that, that's one of the most urgent danger signals that you can imagine. What happens as this process works its way through is that from the outside, what you'll see is in a very short period of time, say 1 quarter, you'll see all these announcements for acquisitions in a sector. And it looks like all of a sudden overnight, everybody wanted to buy one of these companies. But what's actually been happening is this has been going on for a year or maybe 18 months. But you can't see it because a lot of these acquisitors, a lot of the buying companies are public. And I'm sure most of you know that they will literally jail people for leaking that kind of information because the stock will move and people, millions of dollars will be lost by the wrong people because the rumors start in this. So the executives in these companies are terrified of it leaking out. So they are really good at building strong NDAs. They're really good at keeping that information under wraps. They have to be. So if you are one of the target companies, most of the time you don't see this activity building because it's all being built under extreme secrecy. And when this happens, most of the companies who want to buy one will have found one to acquire. It might not have been their first choice or even their second choice, but they've got 3 choices, maybe more. They'll buy one. And then what happens is, almost overnight, those cocky CEOs who didn't know that they should be responding to those phone calls, almost overnight, the buyer interest stops. The phone doesn't ring anymore. And if your company didn't get acquired during that wave, it's almost impossible to be acquired after. And that's not the worst news. After this buying crescendo, after those multiple announcements in a quarter, each of the companies that was successful in buying is probably going to invest a similar amount over the next several years to fight for market share. That's what big companies do. They don't buy the company and then continue to operate like the entrepreneurs did. They buy it and then they spend money on that model to gain share. That's their natural business process. That's what they're good at. And they're quite happy to lose money on their income statement for 3 to 5 years while they're building up market share. And if you were unlucky enough to be a shareholder in one of the companies that wasn't acquired, right after the phone stops ringing, the world changes for those companies. Because now they're in a really difficult situation. Their market has become much more competitive. And instead of fighting with other small, underfunded, maybe angel-backed companies, they're now up against the giants. They're up against companies with enormous investment capability and highly effective brands. And the small companies just cannot afford to compete. They can't operate in an industry where everyone is willing to lose money for 3 to 5 more years. And what's really sad about this is often these small companies were very profitable. And almost overnight, their margins go to 0 and they become unprofitable. And at the same time, their ability to raise more capital disappears. They might have been the hot darlings that the angels were chasing. Overnight, the angels don't want anything to do with them because we're too smart. We've got enough gray hair to know that we don't want to fund a fight against one of the big guys. You know, if somebody came to you and said, okay, our main competitor is Google, number 2 competitor is Yahoo, you're not going to write that check. That's just not a smart investment decision. And even if you did accidentally write the check, you know you're not going to get an exit because you've seen the announcements. All the companies in that space just went through a buying crescendo. That was the end of the wave. Not a smart investment decision. So what I'm seeing that is particularly heartbreaking about this is that these were the companies that were our winners. These were the companies that were very valuable. Often they were very profitable. That wave will destroy both in just a couple of quarters. And I have come to believe that for CEOs that have built valuable businesses, not missing that wave might be their single most important job. Not blowing that is perhaps the thing that boards should be holding their CEOs most accountable for. And this is a difficult thing for me to say because I'm not even sure if I'm being fair to those CEOs because I remember what it was like to run a high-growth tech company. And every waking moment, you're worrying about, selling the product and dealing with the customers and hiring people and all those operational things about the business. And very few CEOs have the time to watch the M&A market for their companies. And very few have the skills, quite frankly. They just haven't seen enough exits to know what those signs are. So I think that if you ask, and most audiences do, okay, well, how do we mitigate our risk? What can we do? Well, I think that the best way to get an early warning on this is actually to talk to M&A advisors. And the reason I say that is that they're not under an NDA at the early stage of the process. What's really interesting about when this starts is that the big companies will start to put the feelers out. Hey, we're looking for companies in this area. So 1 or 2 quarters before this really gets crazy, people in the industry will have heard about it and they won't be bound by the NDA because all it is, it's kind of like rumors. It's not hard information. It just seems that a sector is heating up. And the CEOs can't do this. If they had nothing else to do all day but phone up their competitors and ask, hey, are you hearing anything about M&A activity? Maybe, but it would be like a full-time job. The M&A advisors, their full-time job is just working in the market, listening to the rumors, listening to what whether there's any patterns to the inquiries. And I think most CEOs need help with this. And just to sort of put another perspective on this terrifying process, one of the saddest things I've had to do recently is to help CEOs understand that when they sometimes phone up one of my team or me and they get all excited, they've got a big company that's phoned them making an unsolicited offer. One of those accidental exits. They think, oh, this is great. It's payday time. Big company, fill it in, Google, Yahoo, Microsoft phoned us. They want to buy the company. I hate that I have to probably, as gently as I can, work around to helping them understand it's probably not good news. And the reason it's probably not good news is that it could be the signs of one of those waves of consolidation. And if that's what it is, and by this time it's getting to be fairly obvious. By this time the activity level is getting obvious even to the CEOs that weren't paying attention. If they still have an assistant, the assistant will have noticed there's a lot of people phoning up to buy the company. The problem with that is at that point they're dangerously late. There's still a 6 to 18 month delay before they're really ready. So if they're getting the phone calls, they're not ready to respond. And what happens is, because they're not ready, they're not going to do a good deal for the shareholders. Sometimes companies get sold like that. And again, most of the time it breaks my heart, because the biggest problem with that is they're not going to get a very good price. But it might be the best thing to do. If it is a wave, if it is coming at you, jettison the business. Take whatever you can. It's a distressed sale, the reality is at that point. Get out, because if you don't, that wave's going to crush you on the rocks, and you're likely to end up riding it over the top and getting nothing. So to summarize, on exit timing, like many parts of life and business, timing is everything with exits. Timing our exits better will significantly improve angel investor portfolio returns, and for the entrepreneurs, literally change their lives. So for me, I think it's every company that's successful. If you've got a company that's in your mind successful, somebody has to have the job of watching that M&A market. And I think really importantly, especially in this market, design your exit process. Don't wait for it to accidentally happen to the company. You may get some money out of it, but you won't get what was fair if you let it happen to you. It's every company's job to manage that business process, just like all the other business processes they run on a day-to-day basis. We have a couple minutes left for questions. Anybody? Anything on riding it over the top? Sir?
So a really good friend of mine is going through this process right now, and I've been there as well as the entrepreneur of a company that is at the right time in the right space. And you say, have someone watch the M&A market. What does that someone do? How do you watch the M&A market? Who are you picking up the phone and calling? How does that relationship work?
The M&A market is another market like the market for the company's product. And what CEOs do instinctively is they talk to other people in their business a lot. That's how they get competitive information. With the M&A market, the people that are most knowledgeable are actually the people in the middle, the intermediaries, the people that are in the business of transacting. You can't phone up the big companies because they won't tell you. They can't tell you. Even if you scored a direct hit and said, hey, are you interested in buying a company in this sector? They would have to say, they'd probably say no, even if they were actively looking, because they're so afraid of violating the securities laws. So the M&A advisors are the people that were most likely going to give you information. And I don't think you should pay for this. You might have to pay like with coffee and maybe lunch. This is a normal part of the process. The M&A advisors are also eager to talk to the companies because they might be future clients. But they're the ones that will trade information about the market for information about the company. And that's the best advice that I have. There is no other way that you can get underneath that NDA shroud because of the secrecy. Other questions? Sir?
A company growing steadily, then how, say for 10 years in a row, 15%, and how do you know where the top is?
Great question. Knowing where that peak in the value is not easy. And that's really, I think that's the board's job. I don't think most CEOs will have an opinion, but those, and I would include myself, are just such optimists. They see it going like that forever, right? We don't see the risks. So I think that's where the gray hair and scar tissue that we accumulate running our businesses and then being angels, that's where we can make a big difference. Or if they were so lucky to have a good mentor, that's perhaps where a good mentor could come in and say, yeah, okay, but aren't you noticing there's some margin pressure? How's the win-loss ratio changed over the last few years? How's the competition feeling? These are the kinds of questions that might give you a little bit of an indication of whether the company's fundamental value is peaking. But if you leave it to the entrepreneurs, they've got to be beaten down for a year or more before they're even willing to admit to themselves the best days are behind the company. I think the best way to know if it's a good time to sell is when everything is going perfectly. When you look forward and all you can see is blue sky, I think that's a pretty good time to think about it because, again, there's this 6 to 18 month delay. Stuff is going to happen. And those buyers are smart. If there's a storm cloud on the company's horizon, they're going to see it. So, the thing that you'd always want to sell is a company that doesn't have any blemishes or warts. So when it's going too well, if it's going really well, if it's going too well, then definitely. If you're growing and the margins are good, that's a really bad sign. Because we live in a very competitive world. If you're growing a lot and there's good margins, there's going to be more competition. That's a certainty. It gets very hard to do. It's counterintuitive. I didn't do this, by the way, in my first 6 or 7 companies that I invested in. Completely missed this. But I think if we looked at it as logical business decision makers, that's the right decision. Last question.
I was going to say, like this, the wave idea is something that in today's culture or today's economy is something that's inevitable for any type of business. Is this kind of an assumption?
For businesses that are hot, there are some companies, and maybe the example of a company growing 15% per year, maybe it never enters a hot phase. But these days, with so much capital being out there, we're seeing more and more sectors become hot because there are uncountable smart people in private equity funds, and their view of the world is, we're going to find a sector, and we're going to do a series of acquisitions. So even if it's like, I don't know, hamburger stands or dry cleaners, anything could go into one of these phases where you get 2 or 3 competitive private equity funds, and they'll vacuum up an entire industry. A friend of mine actually made a small fortune buying local detergent blenders. Evidently, detergents are expensive to ship, industrial detergents. There's lots of little companies that would buy the raw materials, blend them up, and sell them in the local market. He just vacuumed them all up and sold them to a bigger fund. I think almost anything can go through a phase like that. So today, it's just one of those things you've got to be vigilant about watching.
And well, just to follow up to that, so you're kind of saying that there's a time to sell, but is there a phase where companies sometimes can just hang on and kind of move through that and kind of like it's kind of like you have something kind of go wrong and there's lots of press and you're kind of having to deal with that, but there's always kind of like a time where things do level out eventually, and I'm just wondering.
Of course, that happens. Because again, I'm talking about statistics. And lots of companies go through ups and downs. Yeah. A lot of times I think what happens is they missed an opportunity to exit. Yeah. And it wasn't fatal. They went through and they found another life, another one of the 9 lives of the cat. Yeah. Hit another peak. They should have sold there. Missed that one too. Then they go through it. And there are companies that will oscillate in their fortunes up and down. Yeah. But I think those were companies that in an ideal world could have sold multiple times when things were looking really good. So it's not inevitable. Waves of consolidation don't happen to even the majority of companies. This is a minority effect. But it happens to the winners. It happens to the ones that are doing really well. That's when you are more likely to be in a situation where it's going to attract interest from the big players. They're going to throw huge resources and huge capital. And the reason I want to highlight this so much is it's so heartbreaking because these were the winners in our portfolio, and we blinked, and they were gone. Just because we missed the ideal time to exit. And then most of the time what the curve looks like is when you miss that peak, you don't usually come back from that. It usually is a one-way trip to a smoking crater. Ladies and gentlemen, thank you very much for being a very interesting audience for me. I hope this has been valuable. I hope you learned something today. I hope this helps you with your exit success rate. Please do fill out the evaluation forms. Those are really helpful to us and to NACO and to G10. Thank you very much.